This is the Self-Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self-Storage Podcast. I am your host, Scott Meyers, and this week's guest is Cory Sylvester of DXD Capital. Cory leads the site selection and investment committee for DXD Capital, and he also oversees the national real estate development team and is a founding principal for Radius Plus. Now, before founding Radius Plus, he spent 6 years investing in technology companies at Columbus Circle Investors and JP Morgan Asset Management. And in this episode, we do a deep dive into the importance of using real-time market data to underwrite and make accurate decisions before pulling the trigger on an acquisition or development. So without further ado, please enjoy my conversation with Cory Sylvester from DXD Capital and Radius Plus. Cory, so good to see you. Welcome to the show.
Thanks for having me, Scott.
Well, Cory, I've given everyone a little bit of your background and on your company, but what I wanted to do now is take a little deeper dive into what you're seeing in the marketplace right now with a focus on the development side of the business. So with that, why don't you fill in the gaps and get everybody up to speed as to how you're approaching this market?
So, the last 24 months, it's certainly been 36 months, it's certainly been a whirlwind in the self-storage industry. We went, from being in call it the 7th inning of a oversupply cycle to, from what COVID did to the industry, the beginning of the next development cycle from our perspective. So in 2020, we raised a $53 million fully discretionary fund to build 10 self-storage facilities, which are either about ready to open or are under construction all the way from Hawaii to Rhode Island. And we just raised a second fund, and we have another 18 assets that are in various stages of entitlement and development underway as well. So we got a lot going on across the country. But obviously the last, 3 or 4 or 5 months have really cemented the reality that, at least from my perspective with interest rates, that the value to be created right now in self-storage really is in just development, more or less, just with regards to, acquisitions are becoming very difficult, both from the fact that, interest rates are going up, but as interest rates go up, your exit caps naturally rise, and those are always going to rise a lot faster than seller expectations of what's a realistic exit. So what you're seeing in the acquisition side of the market is certainly a much larger slowdown. In the development side, there's a couple things going on. With what the Fed just did to interest rates, you've got markets that have a high degree of housing growth that is essentially shut off overnight. And as we all know, self-storage has a high propensity of users that rely on storage that are in the process of buying homes or selling homes. So, in certain markets like that, we are seeing a slowdown in the usage of self-storage. And, conversely, on the other side of it, with this slowdown that's occurring across the country, construction costs are coming down. You're starting to see the forward curves on steel. We're already starting to hear from our contractors that the subcontractors are starting to loosen up on their bids. Last 24 months have been crazy from a materials and labor perspective. So, you get two sides of the business doing different things. Rates are softening on some certain parts of the country, but at the same time, your input costs for building these things are coming down. So it's keeping things very dynamic, having to stay on top of all those variables to make sure that wherever you're building, that the numbers are still making sense. That being said, we are in kind of the 2 worst months for self-storage leasing. September and October tend to be the highest rate of net move-outs from self-storage facilities. So from that perspective, that coupled with what's going on with the Fed, things look, uglier than they've looked in the last 24 to 36 months for sure. But, looking at a macro perspective, this is still the time to be developing. So got a lot of development going on is the answer.
We've been very development heavy, as we discussed before we got on the air here as well, and moving into an acquisition mode. And this every recession looks a little bit different. And this one, with inflation as high as it is, and what we're seeing with the Fed raising interest rates, right now just still doesn't seem like the time to be looking at acquisitions. To your point, you got to create a lot of value. You really got to be buying right and exiting pretty quickly in order to get that exit cap rate and to be able to not have that yield be eroded away by interest rates and rising cap rates. And so development is absolutely the place to be able to create the value. The fear that comes in from many of the folks that are listening right now is we're coming out of an environment in which we've seen nothing but increasing costs and thankful construction costs, and thankful now that yes, those the subs are finally coming back to the table and they're turning bids around pretty quickly so that the GCs can get our bids back to us, which is always nice to see, which that's just human nature, I suppose. But one of the pieces I wanted to kind of dive into a little bit more, Cory, is you've got a lot that in your pipeline right now, a lot of properties that have come online, a lot that are coming online. We're taking a much more microscopic approach to underwriting now. We're no longer is it just a 3% increase in rates across the board and lease up looks the same and X number of units per year. We're looking, to the season, as you mentioned, coming into a tough time, and we're dialing in our lease up rates. And, 1 month doesn't look the same as the next, and then doing our best to really pinpoint as much as possible, getting a lot closer to where we feel we're going to be in terms of an exit cap rate and time frame to hold these projects. So all that to say, my question behind all this is, tell us how you're approaching the market right now. We've got the Fed who's come out and said that we're going to continue to raise rates until we break the economy. And if you're heading into a development project right now where you expect to be stabilized 3, 4, 5 years, how are you underwriting to that, given the information that's coming out in the marketplace right now? And I know there's no magic wand and no magic bullet, but curious to see and learn a little bit more about your approach to when you exit and how you dial in that exit cap rate and then ultimately the dollars at the end.
Yeah. So generally speaking, the way that we've structured the money that we've raised and how we tend to think about it is we never want to be in a situation where we have to make a decision because the capital needs to be returned. So we have long time periods in terms of when we need to return the capital. So, near term, obviously the focus is on interest rates. Long term, I still very much have the perspective that the economy, while we're seeing a dramatic increase in interest rates to combat inflation, long term, the structural nature of what is going to be occurring from a macro basis is that there are going to be low interest rates. And that's not necessarily a prerequisite for our success, but I do think that that's an operating thesis that I have, is that the interest rate increases we're seeing right now is a transitory issue. It could be a 2 or 3 year transitory issue, but at the same time, we're not going to see interest rates, these levels for, 3 or 4 or 5 years. That's just not my view of how the world is going to work and what's needed in order for the government to finance itself and for, the leverage that's in the system to be able to exist without cratering the economy. So for cap rates, we've certainly taken them up. Some of the stuff that was happening in tier 1 markets in certain situations, and cap rates are funny things because until you know what NOI is being used, is it trailing? Is it in place? Is it forward looking? Is it 3 years from now? A cap rate can be a very deceiving thing when you talk about it from a high level. But the way that we think about cap rates is, they have gone up. It's market specific. So we still want to link and anchor ourselves in data. So still looking at, okay, what are recent transactions that have occurred? And then what sort of adjustment do we want to make to that cap rate, given the time between when it occurred and what current environment we sit ourselves in. So it's a very localized, data-driven approach around figuring out, okay, what are cap rates? Well, let's take a look at what realized cap rates have been in the area. And then we can make, qualitative adjustments to that based on, what we think has changed. And so that's how we think about cap rates. From an underwriting standpoint, obviously everything is, from our model, we've had a very conservative approach for quite some time. Obviously, the lead up from 2020 to 2022 saw enormous rental rate growth. So generally speaking, we were always taking discounts to those prevailing market rates in terms of assuming what stabilized rates we would be able to achieve in our ground up developments. Interest rates are probably one of the bigger factors that we've changed within our model over the last 6 months. We saw what was happening on the forward interest rate curves, and right now, we're underwriting between a 7 or 8% interest on construction debt, which is 300 or 400 basis points different from what you saw 9 months ago. So that's probably been the biggest change. Lease ups and the lease up velocities is something that is a function of not only what market you're in, but how large you're building, right? So to the extent you're building 60,000 net rentable versus 100,000 net rentable, what's the density around those locations? We will take adjustments to the lease up velocity based on how many units we have to fill up and what we think the density and demand for storage is in the surrounding area. So that's not a vanilla answer, but we tend to think about lease up velocity as a dynamic of, okay, how many units do I have to fill up, and what is the number of customers and demand for storage, and what is the discount we're going to be using in order to lease up. Public Storage as a third-party manager, if you use their in-place model, they have a very different methodology for leasing up than what Extra Space or CubeSmart does. Public's methodology is essentially driving extraordinary price cuts to the front end of the curve to drive a higher lease up velocity, and then over time raise rate on those existing customers. And then, with Extra Space and Cube or Life, they tend to have a bit of a different approach. So, right now we are using third-party management. We manage the manager, so to speak. So it's there is an element of function of how we think about lease up velocity relative to the operator that we have selected to operate the asset. Rate increases, you talked about 3% increases on the market rents going forward. That's a more difficult number to have any sort of confidence around what is that going to be, both from the standpoint of we've got inflation. So naturally right now rates, prices are just going up much more dramatically. 3% would probably be in this environment a small price increase, but at the same time, we just saw in some markets 40, 50, 60, 70% rate increases. So there does become a point at which you increase rates enough where the demand for storage will fall, because ultimately it becomes too expensive for some people to want to use. So, being very cognizant of what has happened over the last couple of years is an important factor to understand, okay, what do I think is going to happen with market rates going forward? And then on the construction side of the business, we just went through a period where we were carrying enormous contingencies, 10% contingencies above and beyond what a general contractor would give us, a hard number at. 10% contingency in historical terms is a pretty large contingency. But like I said, we're starting to see, steel's been softened for, 3 or 4 months now. It takes some while for that inventory to work through the system and to actually show up in the numbers. But contractors are really now starting to see softening in their bids, because now obviously with what's happening in the housing market, which is basically turned off overnight, the available work is shut down from that standpoint. So any construction opportunity on the self-storage side now has a bigger attraction than it ever did before. So we're going to get more competition for more aggressive bids on the labor side as we, continue to build through this cycle.
So Cory, a few things I wanted to touch on as you're talking. One is third-party property management. We've continued to go back and forth. I've been in this business for 17 years and starting out self-managing until we got too big, and then we went to third-party. Then we brought it back in-house or kept some in-house until we grew geographically, and we didn't have boots on the ground or district managers or regional managers to effectively manage the managers, as you mentioned. So we went back to third-party, and then we went 100% third party and away from anything internal. And now we're getting back to the place where we're going to be launching a property management company just for ourselves. Nothing that we're going to offer third party. That's the last thing that we want to do, but becoming more vertically integrated. And you've been through that cycle as well. You've got a lot of activity. You've got a lot of projects out there, and also a lot of private equity out on the street that you need to do your best to control the returns. Has there been, conversations multiple, or is there never a conversation you're only going to offer third-party property management to run your facilities? Just curious, because it seems to be all across the board for syndicators and principals, depending on who you talk to and how their business is laid out.
Yeah. The approach that we take is not what do we want to do, do we want to manage, do we not want to manage? What is, in the current situation we're in, what is the best structure to create the most value? And right now, in order to build in Hawaii and to build in Rhode Island and to build in Florida and to build in, Las Vegas, there's no other path than using a third-party management platform. That being said, we do have the perspective that at a certain scale, with the right team and the right technology, you could manage assets in a much more attentive manner than I think, some of the other operators could, given that their scale is in the thousands at this point. So the answer to your question today is very much a decision around, okay, I think the best decision for our investors is to use the scale that exists within these third-party management platforms. The SEO recognition they have on the internet is crucially important. The cost of acquiring a customer from that SEO scale is lower. The seamlessness of being able to, turn on operations in all these different places allows us and requires us to use third-party management today. What we're doing big picture certainly gives us the flexibility to be able to make a different decision in the future if we want to. Obviously we started Radius, so we have a bunch of data on that point. We started another company called Managed Space, which is developing third-party property management software, which our view is that, one of the biggest deficiencies of third-party management software that exists today is true revenue management technology that's been integrated into the software. Data science driven, forecasting demand, understanding where the elasticity of rates need to be given the amount of demand and the other factors in the area. So we haven't made any decisions yet, but we're certainly continuing to develop the capabilities on our end such that we have the optionality to make the best decision for our investors, at any given moment. But right now, that best decision is to use the national REIT platforms at this point, which gives us, best in class, general technology and the ability to scale. So where we sit today.
Yeah, 100%. And all those decisions are made given the specific site. And as you mentioned, when you are scattered that much geographically, it's tough to build a team. And again, from where we stand, the regional managers, the area managers, to be able to manage the managers that are on site and to be able to staff them properly and understand the market and market appropriately, and all the SEO and everything you mentioned, you just can't get that unless you're a little tighter geographically. And so as we hone in and understand where our markets are right now, we're mostly in the Southeast, so covering approximately 5 states, and that is where we have decided to create the property management company. But knowing that we go where the opportunities are, we find a fantastic opportunity in a site, then we're going to take it down, and then we'll have somebody else manage it in the same way that we would, but that will be a REIT, and then we will not be internal. So always with our investors in mind, what is going to make the most sense for them and to be most profitable as well. And that leads to my next question that I'm curious as to your capital stack and looking at, progress and activity going forward. We were in New York City, myself and our fund managers 2 weeks ago at one of the large family office events, and talking with many of the family office managers and the folks that run those, and they're being very candid right now and who they're investing with and why and the reasons surrounding it. And the syndicators like ourselves, the discussion seems to be more around scaling back, as institutional investors they understand self-storage and what it does during a recession, but they're being a little cautious. They don't want to necessarily hop on when the Fed says that they're going to break the economy. They don't really want to ride, self-storage even down to the bottom, even though it does better than others. They're just sitting back a little bit. And we're seeing that the folks that were going to start a $100 million fund, they backed it down to 50, and the folks that were starting a $50 million fund are backing it down to 25, just because there's a little fear right now that we haven't necessarily hit the bottom, and it's going downward fairly quickly with regards to rising interest rates and consumer confidence. So both the institutional and retail side slowing a little bit. Can you speak to your approach and what you're seeing out there, and how you're approaching the market and raising capital, and what the velocity of the capital that's coming in for your fund going forward?
Yeah, it all comes back to the timelines, right? So private equity, generally speaking, are not long-term holds. They're looking for tighter timeframes in order to make the math around an IRR look higher. Keeping an asset that you've developed for 6 years, even if you continue to accrete positive value, is not their business model. Their business model is to liquidate and continue to turn that capital so that they show the highest performance metrics. So, shops like that, the larger institutional shops, are not agnostic to when they sell. They have to have a very tight time frame. So they are largely pencils down at this point. Through the end of the year, large private equity shops are not interested in deploying capital in this environment. That's just as much a business decision as it is the constraint that they operate under with regards to the timeline that they have to create value with the capital that they've been given. Conversely, if you look at and speak to some of the more, longer term family office, certainly private wealth capital sources, they don't have that constraint around, okay, well, am I going to be able to exit in 3 years? So they have a different perspective on being willing to use this opportunity to go after opportunities. The funny part is that when capital is in abundance to sign up, you see 19 other people that are trying to go after similar sites or do similar things around you. And when that demand for going after opportunities becomes easier during periods like this, when you just don't have as many people chasing land, you don't have as many people that are going after development opportunities, the capital, the institutional capital sits on the sidelines. So, having the perspective of, like you mentioned, self-storage is not recession proof, but it does great relative to other real estate asset classes in down macro cycles like this, because many different drivers of demand that storage creates diversity amongst your revenue base. So to the extent that you have, new home buyers that are not using storage as much, you have people that are moving into, their parents' home or downsizing that have a need for self-storage. So there's that diversity in revenue. So having the confidence of knowing that, you don't want to be reckless with your capital, but at the same time, there is going to be a certain amount of stability if you pick the right locations in your revenue. So now is the time to be taking advantage of lower land costs, lower construction costs, and accelerating that process of getting those projects started. Because if you put a project under contract today, let's say it's zoned by right, you're still talking at least 6 months, 9 months before you have completed CDs and you're moving to any sort of pushing of dirt, which is another 12 months from then until you open it up. And that's the environment you have to be asking yourself, is that the environment I want to be opening storage in? Generally speaking, if you pick the right locations, that's exactly the type of environment you want to be opening storage in. So it's not, turning a blind eye to what's happening from a macro perspective, but it's at least having a little bit of perspective on knowing that we're going to be okay, even in a down cycle. You pick the right markets that aren't overly exposed to, one demand driver or another, and knowing that, when you're opening your doors, it's going to look a lot different than it does today. And you're not making your decision based on opening your doors in October of 2022. It's having the perspective of, what I want to be opening my doors here, after this cloud passes, which generally speaking is where you want to be. But certain capital doesn't have the ability to have the patience to take that perspective, which is where the opportunity lies. It's not a good or bad thing. It's what exists, and that's why you have opportunity in times like this. If everybody was still taking advantage of the market with that perspective, then there wouldn't be that same opportunity.
The exact conversation that I had with a friend of mine over coffee this morning, who runs a large hedge fund that is not real estate related and is all about perspective. And this marks our third recession. We were in storage in the last one and still in real estate in the 99-2000 recession. But Yeah, we saw we didn't have enough capital to deploy and enough lending relationships to do as much as we wanted to do in 08 and 09 and 10 when the lenders started opening back up again. And certainly wish we would have, and even during 08, because that's when there are lots of opportunities. And so the perspective that we have is, I look back and we saw the REITs and some of the other larger national players that had bigger pockets and great relationships could go out and develop. And those are the ones that, when things begin to turn around again, they were sitting in really good position. And so we've been preparing ever since then to do that same thing and increasing our equity partner base and joint venture base, as well as our relationships with lenders, knowing that this time was coming. And so, nobody celebrates a recession or a pandemic, but we know that we're in that asset class that is very recession resistant. And so we're excited. We're looking forward to what the next several months looks like. And quite honestly, the next 2 years or so is it's going to be a great opportunity for us. And now also, now that the noise has calmed down a little bit, there's a whole lot of folks out there, raising capital and doing business that weren't very helpful for the rest of us. And so now that some of that noise is gone and some of those folks are sitting on the sidelines because they don't have the capital and they don't have those relationships, we're looking forward to getting back to business with the folks that we've been doing business with and things calming down a little bit. So that said, Cory, what are you looking forward to the most as we head into the next, say, 2 or 3 years operating in this environment?
I think it kind of just goes back to what we were just discussing, is that to the extent that you can maintain discipline around doing the deals that you think ultimately are going to drive value over the next 2, 3, 4, 5, 6 years, remain steadfast in pursuing those, because then you're going to be the first one out of the ground. And that's half the battle. And, I'm looking forward to getting through another recession and having another case point around how storage does in different economic cycles. And every recession that occurs, people always have the same perspective of like how awful things are going to be. And in the moment, it feels horrible, but when that cloud passes, people become more rational and realize they should have been investing through that cycle. And it's difficult to do that. So I'm looking forward to being prudent with our capital and continuing to invest, having the perspective of knowing that, we are in, one of the best real estate asset classes that does well, even in turbulent times, and seeing storage continue to do well as we come out of this next cycle.
Well, Cory, certainly you've done very well, and it is that disciplined approach and looking at the numbers and doing your best with the information, the data that you have at hand to make those decisions. And so Union Real-Time and Radius Plus is born out of your not only passion for that, but also because that's your skill set and your gifting. Talk a little bit about, if you would, how you've approached this market and in terms of the data sets. I wouldn't say any market, any project, with the data that you've created, the data sets that you look back on, and then how the business was truly born out of that.
So the way that, when we came into storage, the biggest metric that people talked about was square feet per capita, which, historically has been, one of the easiest things to quantify. Prior to the internet and having visibility into rental rates, the only sort of supply and demand metric you could quantify was, okay, how many people are there in a given trade area and how many square feet of storage, square feet per capita. That makes sense. I think that how we think about really where to look at the data is not that we have a special AI driven algorithm around, where the answers lie, but it's around, thinking a little bit outside the box around square feet per capita. It can be an informative metric as a, secondary thing that you look at. But, the way we think about data, on the DXD side and how we try and inform people on the Radius side is rental rates. Rental rates change like airline rates. They change every single day. So your real-time assessment of supply and demand in a given area is the prevailing rental rates in an area. And that's, quite frankly, as simple as people need to make it. You can take a look at square feet per capita after the fact. And, to the extent that you have high rental rates and high square feet per capita, that's actually a great thing, because it means if you're adding supply, the incremental amount of supply you're adding to an area is actually small on a percentage basis, versus where people get lost is, there's only 1 or 2 square feet per capita here. Well, yeah, that's certainly the case, but
that could be because there's not a high demand for storage in that area. Mm-hmm. And if you're adding 100,000 net rentable square feet, you could be increasing your trade area by 40%. So people have always been very fixated on square feet per capita, which I understand the historical reasons behind. But getting back to your question around data sets, I think people would benefit a lot from thinking less about square feet per capita and more about the prevailing rental rates. You model a facility based on what the rental rates are you're going to achieve. It's not based on what square feet per capita exists in the market. That has nothing to do with creating a revenue model. And, I think there's certainly a class of people within this industry that are taking that approach, but there's certainly still a lot of people that look at it on, okay, I'm just interested in finding where square feet per capita is below 5. I think that's an incredibly inefficient way of using time and resources to finding opportunities that, may not exist. Because if you find a square feet per capita of 3, but rent rates are $12, that doesn't really do anything for you. I'd rather find an area where rental rates are $30 and square feet per capita is 9.
Right.
So, that's quite frankly, there's a lot of other data we look at. So I don't want to oversimplify too much, but helping people, that anybody that's listening to this thinking about getting into storage or wants to understand the investments that they're getting into, start with the rental rates. What's going on with the rental rates? That's what matters. At the end of the day, all the other metrics, incomes, population, square feet per capita, they all flow into what rental rates are. I mean, the rental rate's telling you the net of all those other metrics. So focusing on rental rates is where we've been, focused, since the get-go. And I think that it's the most informative and valuable data set out of all data sets that you can be looking at to inform decisions.
I think when I look back, when I got into the industry in 2005, that was it. It was rental square footage per capita, per person, period. And there was associations that would publish a book once a year, and that was what folks looked to, which is kind of hard to believe when we look back on it now. And now fast forward, 16 years later, and you talk to the consultants doing feasibility studies, and they say the exact same thing. They say, well, square foot per capita is really out the window. It doesn't matter. I can go to Florida into a market that's 12 square foot per capita, but all the facilities are full and they're raising rates. Part of that is Florida. There's no basements, and there's a lot of folks moving into there. And so demand is a huge factor. And that goes into any market in the country. And then now, they're saying that's, all that's important, square foot per capita. Demand, you layer on top of that, but it's rental rates, especially if you're going to develop, because when you model everything out and you reverse engineer and go backwards, it doesn't make sense to be able to build at this cost if rental rates are at this price per square foot and you're modeling it out at 85% occupancy. What does that look like? All things being equal, if you will, heading into it. So that also goes back, I guess, to where we started, which is you can't just put any of these industry metrics in place, these, the long-standing metrics that have been around forever, and apply it to a model. It needs to be more dynamic, just like airline rates and anything else is going to change. And the folks that know what levers to pull and which ones are more variable than others are the ones that are going to win in this game. And it's all about having the data, period.
Exactly.
Well, Cory, I absolutely appreciate your time and appreciate everything that, first of all, admire what you're doing from afar. You guys are doing exceptionally well in all areas, especially on the investment side, but to appreciate your dedication to putting that data out there into the hands of those of us that are looking to acquire and develop and grow the business. And you've given a lot of nuggets, value bombs for folks that are looking to get into the industry, but we got a whole host of folks across the gamut of the experience level and self-storage beginners, as well as savvy folks. What word of advice would you give them, or words of advice would you give them as we are now heading into this economy that is shifting gears?
If you're not partnered with somebody who has experience in storage, you shouldn't be getting into storage. As simple as the game sounds, there are a lot of nuances from how you build the facility, where you build the facility, how you think about the management of the facility, how you model, self-storage investment. It's certainly not something that's rocket science, but from the standpoint of anybody that's looking to get into the game, find somebody that you trust and that has reputable experience if you are getting into the industry. It's certainly something you can learn over time, but I would not be placing capital in this industry with what's going on without a partner that has had some time, has some perspective on what matters, what doesn't matter in this industry. So while it's easy to get into storage, generally speaking, whether you're acquiring or whatnot, make sure you have a partner that knows what they're doing.
Generally easy to get into the business, and it is a simple, predictable business model, but it doesn't mean that it's a simple business to produce the returns that are needed on the back end. There's a whole lot that needs to happen between entry and exit. So 100% agree. And folks, I did not pay Cory to say that, but as you all know, that we do joint ventures and do mentoring and coaching. So if there is any assistance that you're needing in the way of resources, obviously those are available to you. But I echo that. If you don't get help from us or from the likes of Cory and his business, then get it from someone and somewhere, because no business is a hobby where people treat it that way, where they think it is easy to get in and out. It is a business, and no business is easy. So Cory, once again, thanks so much. Great to see you again. Looking forward to seeing you hopefully at the next show. Perhaps it's Vegas in the spring, or maybe between now and then we do a follow-up and have a round 2 to this podcast. It's been great doing a deep dive to find out what you're doing and how you're approaching the marketplace. And again, just appreciate your time.
Yes, sir. Thanks, Scott. Appreciate you having me.
All right. Thanks, Cory. Take care. Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.